Good morning, listeners. It's the day we get an update from our central bank on the policy front. But before that, let's dive in the updates that we have for you guys at Almus. This is Almus Market Mornings with me, Shikhar Garg. It seems the market participants have widely accepted the notion that RBI will break the 50 basis point hike trend. A fall in forward premiums would definitely be one of the things running on their minds as the annual forward premiums have dropped to 1.8%. And apart from that, they would like to see the yields being attractive enough for the flows to come in. Probably also because we are seeing lower inflation in the Indian markets than in the US market. The forward premiums can be dropping for this one particular reason. This is something which is happening after decades. Other than that, we have the US banks seemingly increasing their rate of warning for the impending recession while oil takes a fall on that. Brent reached below $80 sign. And this brings me to wonder where and how all those projections were working when we were hearing about oil reaching 150 to 200 per barrel. JK, what's your expectations of the market as well as what's your expectation of MPC today?
Yes, good morning. So we start the active period of the week today with the RBI's MPC. Although still yesterday things were relatively calm, excepting in the rupee market in India, which has seen a lot of volatility. In the global markets were quiet yesterday in terms of economic news, mainly US only had the trade deficit number, which actually worsened compared to previous month. Europe provided some interest. Construction activities slowed down in UK and Europe, but the factory orders in Germany was encouraging, coming at 0.8% from 2.9% last month. Adding to positivity was the car registrations in Germany jumping 31.4%. So why I'm mentioning is that the European economy does give a picture of stabilizing, particularly after the energy prices have eased, even as the winter comes milder and the gas storage levels are comfortable. US trade deficit, as I said, narrowed down, but that did not have much of an impact on the US dollar. And it perhaps dollar is looking a bit supported after the risk sentiment worsen. Before the US session, or rather in the Asian session, we had Australian Central Bank raising interest rates to 10-year high by raising it by 2.25%. But mostly it was seen as a hawkish move, projecting that more hikes may be needed to cool the inflation, and a stance taken slightly slightly hawkish by the markets that were looking for signs of a pause in the near term. Interest also surrounds Chinese trade balance and the European GDP data later today. It was another down day for stocks, with major US indices losing more than 1%, erasing all of their previous week's gains as traders mulled over future economic prospects in a higher rates regime and what the Fed would do next week in terms of rate hike and projections. Market still projects 91% chance of a 0.5% hike on December 14th, while expectations for February will hinge on the upcoming inflation data. As you said, we had the CEOs of major financial institutions, Goldman Sachs, JP Morgan, and Bank of America warning about not only the impending slowdown, but also job cuts again. So this is the first time it's happening in the financial institutions, probably because we heard about it in the tech companies. Weak stocks led to bond market stabilizing, or rather rallying, yields dropping, but more at the long end of maturities than the short end. That deepened the inverted yield curve to 83.7 basis points, which is a new low since 1981. A general sense of impending recession is definitely increasing, and outlook for stock darkens while bonds can remain supported. Fed decision and statements will depend on how they weigh between slowing growth and inflation. Definitely, it is some balance that they have to strike, and the upcoming data should provide the clue as to this. Eurozone government bonds also fell after two European Central Bank officials signaled inflation and rates may be close to peaking in the run-up to a raft of major central bank decisions. It will be a huge week next week in terms of central bank policy decisions, as US, UK, Europe, and Switzerland will be the major economies to see the central banks meet, while rate decisions are also due from Taiwan, Philippines, Norway, and Mexico. Today, we have a decision from Canada as well, expected to hike 0.5%, while Brazil central bank meeting today could hold the interest rates steady. The surprisingly strong jobs data last week and ISM services data this week have stalled gains for the major currencies, with the risk sentiment also soaring. So we are seeing both Euro and GBP seeing some profit taking at the higher levels, even dollar yen seeing good bottom around 134 levels, and I think we slipping into even narrower range, even as the market thins out for the upcoming Christmas vacation period. Of course, the Indian market today will be glued on to the policy announcement by RBI at 10 a.m. and the interest surrounds around how much the hike will be there. When the market has a consensus of 0.35% on the rates, I won't be surprised personally if they hike by even 0.5%. My reasons are that the inflation is still, even at 6.77% last month, it is still at a much higher level and above the threshold of 6% that can be tolerated as per the mandate given to MPC. And the Fed rates are likely to go up by another 1%, if not more. And to maintain rupee stability, it's important that rupee's minimum attractiveness is maintained. So that may be one more consideration, the global consideration for the RBI. And RBI's medium target of CPI inflation is, as we all know, 4% with a band of plus or minus 2%. That means 6% is the cap, but that has been exceeded for 10 consecutive months this year. In order to come within the mandated limit, RBI may go for 0.5% in my view, and maintain the current level of current stance of accommodation withdrawal. As per projections, we feel RBI may revise down the growth rate from 7%, with influence coming from a sharp moderation in exports and the manufacturing sector. Growth projections of India by various agencies have been slightly lowered of late, but the positive surprise, yesterday was World Bank revising upwards to 6.9% for 22-23, and that is an upward revision from 6.5% they had projected earlier. And now the upgraded projection for 6.9% is the first by any global institution for India. So that's one positive news with which we are starting the day.
Okay, wonderful, JK. And yes, folks, we wouldn't be surprised if RBI comes up with a 50 basis point hike, considering the inflation continues to stay higher. But all said and done, it's actually a very difficult task. It's like walking on a thin rope, balancing between the inflation and the growth concerns. And I think even the Fed are on the same lines when they come up on 14th of December next week with their decision on the policy front. It is going to be a much awaited update, as many folks are expecting that even they will tone down their policy on the rate hike front. Apart from that, yes, we have received some data updates, but all in all, we are entering into a busy week now, or the active week now, with a lot of data releases awaited, majorly the Chinese trade balances or the Eurozone GDP updates, as well as what are the rate actions by Canadian and many other central banks. Folks, but one of the good updates that we've been seeing is Eurozone have been stabilizing in their activities with the kind of car sales data and such data releases we've been seeing. So it comes to see how things are acting up in the financial markets, and we shall be bringing up all these updates right for you. As of now, we have the RBI MPC at 10, and we shall bring up updates about that soon. Thank you so much for listening.